Hello, everyone. Welcome to the weekly roundup. Today, we will cover U.S. tariffs, oil prices, and earnings releases. Hello, Ben.
Hey, Eva.
How's it going?
It's going great. Sun's shining. We're doing good.
Okay. We're
Yeah.
gonna dive right into it with one of the major news in the past few days. New U.S. tariffs, and this could hit a wide range of Canadian products. So which industries and investments appear most vulnerable? And do we see any opportunities here?
Hmm. I think that's a great place to start. I think that it continues to astound me that this is the same tactic. Every time we're not happy with something that's going on, we decide to tariff. And so I think we're going to be in the round, though, before I answer that question, I think we're going to be in this cycle where we go, yeah, things start to even out, trade relations are positive, and then we're not happy with something you do. So we're going to tax you or tariff you or whatever, that regard. We have a positive news announcement, like the bridge between Windsor and Detroit is going to open. That's actually going to be a little bit less expensive than the current path. That's going to save companies money, and then bang comes back out with these tariffs. So, I think it's going to hit similar industries that it did before. I think the real target continues to be the car companies and the businesses that are producing cars, and Stellantis and these other companies, Magna, these companies that have inputs that go into the manufacturing process of cars. He's going to continue to try to attack dairy and all of the things that are big attention-grabbing items. Ultimately, I think it's a risk to some further pressure on manufacturing in Canada. Our manufacturing sector has been hollowed out, one of the worst in the G7, and so this is a further target at that. So I think that's not great. Carney, I think, has done a reasonable job of reacting and not playing into this. They were supposed to do a big celebration with the Gordie Howe Bridge opening, and he said, "No, we're not interested. Now that you don't want to negotiate with us." So I think he's been doing a good job of pushing back when these events happen. But it's a further risk to the manufacturing sector, particularly in Ontario, and so we'll have to see. And the question is, where are the opportunities? I think the opportunities are probably not super clear, except for from the perspective that we do have these facilities, these capabilities. If companies could look to pivot and maybe turn towards, yeah, potentially military business, like working on machines and cars that go out to military or munitions or something along those lines. It's going to take a bit of a creative pivot to see how that could be a benefit to Canada. I mean, for the most part, everything that Trump's done since he got in has really forced Canada to look away and look at where their better partners are. They have actually increased their partnership with Mexico, and that's had a nice uptick, as well as Europe, of course. And one of the things that we've seen more recently is we saw Germany and France say that they're moving away from Microsoft for their cloud business, and they've been shifting that towards their own independent businesses. They've asked Canada as well if they want to participate. So, long-winded answer to the question, but really, I think it's all of this is forcing Canada to look at how do we better diversify our exporting partners.
Um, Oil prices are surging again, and inflation fears are coming back.
Yeah.
Could the central bank be forced to raise rates or at least keep them higher for longer?
So I think it's a great question, something to think about. The natural bias is to think towards the COVID type inflation that we just went through, and it feels like that's still kind of the narrative in the media and news, is that we remember this, so X happened, so Y is going to happen. And so I think because this is pretty narrow right now, at least on energy, um, yeah, I think it's going to potentially force them to hold longer than maybe they would want to, as opposed to raise. We'll see. We had the ECB come out today and decide to be said they would be on hold, but the next meeting's in September. They said if inflation continues to pressure higher, then we'll have to raise. So we'll see. They're talking about that. From Canada point of view, we saw the inflation print that was less than expected on Tuesday. So I think that gives the central bank in Canada a bit of room, and so likely on hold. Our economics team's view is still Q1 of next year before they consider raising. There's lots of ground to cover between now and then, but the elevated oil prices certainly aren't helpful. But on the other side of that, you're seeing the economy slow. So if the economy is slowing and you're getting inflation, you got this kind of dreaded stagflation that everyone talks about. So I'd say, I think the central banks are in a real tough spot. But because the economy is slowing and inflation seems to be moderating, I don't think there's an immediate pressure to the upside.
And my last question, I mean, what is a recap without AI? So major technology earnings are, showing renewed concerns about the massive AI spending.
Yeah.
What does this mean for investors? What is the real risk here?
Yeah, I think the real risk is that the markets finally say that's enough. I mean, Tesla and Google or Alphabet came out with their earnings and they had a huge AI spend, and the market said, we don't really like that. Meta came out last quarter with their AI spend, and the market didn't really like that. I think that the risk is that we see this knock on, and we've talked before. I think we're in somewhat of a bubble in this
Yeah.
space. Doesn't mean it's bursting tomorrow, but it's inflating. And ultimately, coming out of this is there's a lot of new good businesses. There's a lot of creativity that's happening within these companies. But when you have overspending, which is what's going on right now, eventually the market's going to say that's enough. I'm not sure we're there yet, but we're certainly, as these earnings have come out, we're starting to see and lean a bit more that way. We haven't seen higher highs in the markets, and that's tending to tell us that the market potentially roll over. But yeah, I think AI is going to continue to be a part of our future. I mean, we use it on a daily basis, as you know, and I think every good business needs to integrate it in a way that can help them be either more effective or more efficient. But behind the scenes, it's chaos from what I'm told within the technology sector, that they're just chasing each other, trying to go faster and faster, more efficient, less battery power. And I think it's something to think about. I'd say my last point on AI is Meta, for the first time, have started to sell their space. So where they have their data farms, now they're starting to sell access to their farms as a business, as an additional revenue line. So that tells me two things. One, potentially that's a positive for Meta because it's an additional income line. And two, maybe they have too much capacity, which is not great, and something to be conscious of.
Let's see the charts.
All good? All right. Okay, so we are recording this on Thursday, July 23rd around 1 p.m. So anything that happens between now and next Thursday, I'll comment on then. Let's jump on in. It's my anniversary today, so it's a good day. As we start with, I just thought these charts were really great to look at. This is from ISI Evercore, and it's just a view on real estate in the US. And the chart I put out today in the daily was really to show that consumers are actually starting to struggle with their payments. You're seeing debt levels rise. And one of the major factors in that is housing. And so the US housing market plays a major role for the health of the US consumer. US consumer is a major contributor to GDP. So all of these things are connected and knock on together. But on the left-hand side, we're seeing housing starts roll over here, starting to tick lower, kind of new lows, new recent lows. And if we look in the middle here, this is the US 30-year fixed mortgage. And so you're looking at Freddie Mac, so 6.55. So if we look at the 30-year bond right now, it's around 505. Mortgages in the US are priced off of that. So right now you're looking at the 505 plus to get to 655. Somewhere between 6.5 and 7 tends to put a lot of strain on the US economy. And then the last piece on home builder survey. So again, home builder survey has been terrible and gotten worse. And that's a factor of the interest rates primarily. And so my view ultimately still is that rates need to come down on the long end. And so it's either going to come down because the world's in a panic or the economy's rolled over into challenging recessionary numbers. So these are important pieces to say, how healthy is U.S. economy? My answer is it's starting to struggle. Couple that with your question just around AI and markets. I think these two factors really are another piece that you need to think about. Are they going to raise rates or not raise rates? Because inflation is important, but so is the economy. This is one that's telling me there's some strain in the US economy right now. Next one, because geopolitics obviously is the story of the day since President Trump's been in. So world normalization unlikely before fall. So this is the probability of traffic through Hormuz return to normal. So Polymarket, great place to actually look at stats and think about what it means and what it looks like and how people are betting or not betting on pretty much everything you want in the world. But I thought this was a great view and look. 11% chance of things being normalized next month, 23% chance September, and then a 50% chance by December. Why this is relevant is because it has an impact for what the market's going to do. Because the market is thinking there's a coin toss chance that this will be settled by the end of the year, there's not too much panic. If we see either of these things start to move in other directions, say this becomes 0% chance, then you probably get that oil spike. If this becomes 100% chance of a settlement, then you get a sell-off in oil. So it's an important component to think about. Polymarket gives some interesting statistics that you can't find out in the everyday stock and bond market. Next one is expected actions by the central bank by end of the year. So this comes back to your question, Eva, just around what do we do from here? Canada has one view, US has another view. So you're starting to see this diverge where Canada, you're starting to see likelihood of a rate increase is moving lower and lower as we speak. And that mostly has to do with inflation getting softer and the economy stalling. Where on the US side, Federal Reserve, you're seeing inflation continue to tick up. My view is that has a lot to do with the tariff and trade issues. Ultimately, that's putting pressure on the US consumer, all of these trade tariffs. That's flowed back to pressure on the US consumer. That's flowed back to inflation pressure. So you're seeing that divergence. This could have a big impact on CAD US, but an important chart to watch from perspective what could happen in North America. And just the last one, like to just think about what we're doing in portfolios right now and trying to look for opportunities because there's been a lot of stocks that have done quite well. On the Canadian side, maybe you've owned some of the banks or Power Corp or some of those names that have done very well for the last couple of years. It's a matter of sifting through and saying, where are these other potential opportunities to make some money from here going forward? What lines up with their views? This is a company called WSP Global, which is an infrastructure and energy company. Great business. Stock's been beaten up. Recent pressure. I think there's a lot of opportunities to look at here. This gives a great breakdown for where they can participate, energy transition, infrastructure. I think it's a good business, really good. Started to add this into portfolio, and I think it's something that we'll continue to watch and look for how to make money from here. Look for companies that nobody likes that have good business models and are prepared for growth. Oh, yes. Last piece, can't forget this one. The opinions expressed do not necessarily reflect those of National Bank Financial. Everyone's risk tolerance is different and unique. If you have any question about anything we talked about today, please feel free to reach out to Eva or I, and we're happy to address and discuss them in detail with you.
Probably the most important slide.
Can't forget that one.
No. So what's on the agenda for next week?
Yeah, so we have the Fed out next week on the 29th, so FOMC next Wednesday, I guess. So that'll be the thing to watch next week and see what Warsh is saying and doing. I think I'd like to get to see and hear more and more around what he's doing and how he's thinking. Because coming into this, there was a lot of things he talked about he was going to do, cut interest rates, not buy back bonds on the further end. Also said he would do away with the forward guidance and dot plots. So he hasn't done any of that yet. So I'm not sure if he is the type of person that says what he needs to get into the chair and then doesn't do any of those things, or is just waiting to take his time and understand all the business before he decides to take action. So I think what he says is going to be more important than what happens. I'd say there's a extremely low possibility that anything happens in the meeting next week, but what he suggests and talks about going forward, I think is going to be an important thing to watch.
Okay, great. Thank you, Ben, and happy anniversary.
Thank you.
Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video and in your email box if you're subscribed. For our clients, as always, please reach out to me if you have any questions or if you'd like to book a portfolio review meeting with Ben. Thank you, everyone, for listening, and enjoy the rest of your week. Bye.
Thanks, everybody. Bye.